Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. This week in our Investor Education Initiative, we talk to working professionals to find out how the SIP can fit into your monthly budget and how it can be the tool you use to invest for the long term. Quick round of introductions in the studio. Wonderful large audience this afternoon with a lot of questions for our guests. Hemant Rustagi, CEO, Vice Invest Advisors. And Kishore Shetty, Director of KFIC Securities. Gentlemen, thank you so much for coming in. I want quick answers from both of you. There are a lot of options. If I want to invest, say, for my retirement or for my child, there are insurance options right now. There are mutual fund options. There are lump sum investments. I can choose an FD and put in whatever I can. What makes the SIP a smart investment for a working professional with a salary?
An SIP basically is an instrument which helps you to invest small amounts on a systematic and sustained manner. One. Secondly, fixed deposits are not investment options per se because they do not allow you to outperform inflation. So when you're looking at the long term and you're looking at goals for yourself, then fixed deposits are definitely not an option as such. It's always good to have an equity component in your strategy because equities always outperform on the long run. And along with that, with the positive government policies, equities have been given a tax shelter.
Even how do we quantify long term here? Because a lot of times we get investors who write in saying that I want to start an SIP. I'm not really sure how to decide how much that SIP should be, and I can't decide with asset allocation that I want. So obviously this comes down to deciding whether or not it's long term or not long term. What is long term technically in your book?
Well, I think there are two important aspects we need to look at. Unfortunately, whenever we talk about SIP, it's always equated with equity, which is not the case. What is SIP? It actually allows you to invest a fixed sum on a fixed date in a pre-decided fund. So what it does for you, it brings in some kind of discipline. Most of the investors are not able to achieve their investment goals because there is no discipline in the investment process. The moment you sign up for SIP, you're committing that you're going to be investing fixed amount every month. So that is the beauty of SIP. Looking at what asset class you should invest in, I think the key factor is, like you said, there are issues always, how much should I invest and where should I invest? The key factor is very simple. Do a goal-based investment approach. You define your goals. You have short-term goals, you have medium-term goals, you have long-term goals. And if you're talking about a long-term goal, you said, what is the long-term? That defines your long-term. If I'm investing for my retirement, for example, which is 15 or 20 years away, for me, that is my long-term goal. And whenever we talk about retirement planning, there are two aspects you need to look at. One, you require a huge sum of money.
What if I'm going to retire in the next 5 years?
Exactly. Look, it always makes sense to start investing as early as possible for retirement. But if you have not done it, okay, the day you realize that this is the time for me, start it. The good thing about mutual fund is that there are investment options for you irrespective of whatever your time horizon is. You can invest in balanced fund. You still have 5 years to go. Focus on that rather than worrying about what you have not done.
All right, we're going to try and take in some questions from our audience members. Anybody in the front row with a question?
How do you compare various mutual funds? Is the net asset value a right indicator to compare the various mutual funds?
No, I think that's a complete misnomer. What is the NAV has no relevance at all. The NAV growth always happens in terms of percentage. You need to look at what is this fund suitable for you. First thing is you decide asset allocation. Don't go into the investment option straight away. Look at what your time horizon is. So for example, investing for long term, then you look at well-diversified equity fund. Now the question is, which diversified equity fund, right? Practically, my view is that you should invest in a multi-cap fund to begin with. Because you need large cap, you also need mid-cap. It's very difficult for you to decide how much should go into each segment. Go for a multi-cap, primarily the fund which have bias towards large cap stocks. Go for fund which are consistently performing well. Now when I talk about consistency, there are two things you need to look at. Every fund has a benchmark. See how the fund has done vis-a-vis the benchmark. Second is the peer group. Every fund has a peer group. I think to me that is more important. See how this fund has done, in comparison to the peer group. So go for fund which are consistent. I think that's the key.
In fact, I also want to know, because a lot of times if I'm comparing my fund to either its benchmark or its category, I could look at the last 1 year, I could look at the last 3 years, I could look for the last 10 years. Ideally, what is that range of comparison that I should take?
I'd first like to answer his question about NAV. Normally, you must manage your expectations. Normally you look at an investment proposition from one, protecting your money from inflation. And if you look at inflation in this country, it's traditionally around 8 to 10%, assuming. And that's where you need to invest to protect your money. And at 12%, you're making serious money. People, unfortunately, today are expecting returns of 18 and 20%. Even at 12%, I can give you a small example. If you look at only your public provident fund, which gives you 8%, and if you invest 5,000 rupees a month for the next 30 years, you're going to end up with 89 lakhs. That's an 18 lakhs of investment at 8%. And at 12%, that money goes to 1 crore 89 lakhs. A 4% differential results in a crore of increment in your savings. Now the question is, why do you need to take that kind of risk? You have to take measured. So your expectations should be managed. So when you look at NAV, people look at NAV and people talk about NAV. It's important to find out what's your expectation. And that's the key, not the NAV. It's the rate of percentage, what's the expectation. And you need to be sure about what your goals are and the percentage that will help you to achieve those goals, rather than being romantic about your 18 and 20 and 25%. You talked about long term, and you're not looking at long term. Long term is basically a goal oriented, as Hemant said. It depends on what you want to invest in and what are your goals for investing. If it's a marriage for a child, education. Today, education is the most expensive proposition. So how do you save for the rainy day? When your child suddenly becomes 18 and you have to get an admission to a medical college or an engineering college, and where's the money coming from? So as I mentioned to you, at 12%, if you're putting in 5,000 rupees, and as I said, you can calculate that mathematically, you go to 10,000 and that whole time frame comes down. You put 15,000. So what I personally advise people is to start small and gradually increase the pace of investment, depending upon your income.
Let's take a few questions on this side. The gentleman in the front.
Yeah, hi. I've been a working professional for the past 15 years now. I'm a little bit averse to investing directly in equity markets. So are there any mutual funds which have exposure to the debt markets as well?
Of course.
Well, of course there are. You see, the misconception about mutual fund is that they're all about equity. I think the good thing about mutual fund is that they offer a product to you, even if your time horizon is a day or 1 decade or 2 decades. There are a number of options. They allow you to invest in different asset classes like equity, debt, and gold. Now, you said you're averse to equity. Yeah. Obviously, I'm sure you have your own reasons why you're averse, because you must have heard people losing money, or maybe you have lost money in the past. I think it's all about how do you invest and what is the investment approach. Equity investment, for example, it requires a time commitment. It requires 2 things. One, you need to think long term. The second thing is you need to invest systematically. Yes, as you said, there are different funds which invest. There are hybrid funds. Today, for example, there are funds which invest in equity, arbitrage, and debt. Okay, now you can decide what kind of risk you want to take. If you say that not more than 25-30% of my money should go into equity, there are products you can design a portfolio. But again, my advice to you would be rethink on equities. Okay, for the long term, you need to beat inflation. There are 2 risks that we take in our investment. One is the risk of losing capital. Unfortunately, we always focus on that. For a long-term investor, the biggest risk is inflation. The moment you keep your eyes off inflation, suddenly what you will see when you get there, you will see a huge gap in what you needed and what you have accumulated.
All right, we have to take a very quick break, I'm told, but we'll come right back and answer more questions. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. We have a raging conversation going on in the studio right now about whether or not we should be using mutual funds and how long you need to stay invested. Right, I want to take a question from the lady in the back.
Hi. So basically, when we are comparing the returns on mutual funds from 1 to 3 years, generally what we find is returns over 1 year is higher than the returns over 3 years. So question is, how long do you stay invested? Should you exit, after 1 year? Or should you stay for 3 years or more?
If you look at last 1 year, the markets have done very well. So you'll find that average return is around 48-50%. If you look at a mid-cap fund, maybe much higher. And the reason why the 3-year return will be lower than that, because that's an annualized return, right? This is the absolute return. So the impact of that getting into the yearly return over a period of time takes time. So which is not to say that every time this happens. This is not a trend. It happens during the time when the markets suddenly, start moving upwards.
If I've noticed that my mutual fund has done really well over the last 1 year, there's a temptation to take the money out and say, okay, I want to take this money out before the stock market comes back down again. And I know there are a lot of investors who do that, and timing the market is very dangerous. So is it important then for me to remember the goal that I put this money in for?
Yes, absolutely. You see, I tell you why this happens. It happens because somebody comes and says that you can make good money in equity, and the best way is that if you don't have lump sum, start investing through SIP. So you start investing SIP. The mistake most of the investors make is they don't have a defined time horizon in mind, and everyone is focusing on making money. So the SIP does not protect you from the risks which are there associated with the asset class. It reduces it. It allows you to benefit from volatility over a period of time. So I think the key factor is if you define your time horizon. For example, someone who is investing for a child education or retirement planning, you have 15 years to go, 20 years to go. Why should you worry about volatility today? I think keeping a goal in mind and time horizon in mind allows you to stay put. When you don't have a time horizon, you don't have a target. We talked about if I made 30%, what should I do? My point is I want to accumulate a corpus over the next 20 years. Why should I worry about 30? And what you do is 2 or 3 years before you retire, start transferring some money to debt to protect all your gains. Not completely, but that's the way to go about it. Allow it to accumulate during your defined time horizon.
All right. I want to take a question from the back here. Yes,
the insurance-based retirement plans are better, or investing in a SIP is better?
You have two different needs. You have insurance needs, you have investment needs. The moment you're looking for a product which puts everything together, somewhere you're losing your focus, somewhere you're spending much more. For example, if you look at that kind of option, okay, the returns are going to be very, very low. You can see that expenses are going to be higher. When we talk about SIP, it allows you flexibility. It allows you to increase the amount when you wanted. It allows you to put money in the asset class that you want. There are many more options available from the mutual fund than what the insurance company can give you, even within an equity. If you happen to be an aggressive investor, you can look at some mid-cap fund or some large-cap fund, or depending on what kind of profile you have. So, if you separate these two needs, what then happens is you go for a term plan, for example. A term plan, as we all know, you buy online, is very, very cheap, right? In these kind of plans, you will not get the kind of insurance cover you should have. Okay, it comes as incidental thing to you. You need to look at, if you apply the thumb rule, for example, if your income is, let's say, 10 lakh per annum, so the thumb rule is at least 10 times of your income you should have insurance cover. So go for a term plan and then invest separately through a mutual fund. Like I said, it gives you more flexibility, more potential for return. Expenses are going to be lower, and I think the performance-wise, my view is what I've seen in the past. This is a better option.
Kishore, I want to bring you into what you said about inflation when you were talking about it.
Precisely.
If I do a traditional plan, I'm entirely in debt and I'm not in equity at all. So
absolutely. See, in elaborating on what Hemant said, see what you need to do from an insurance point of view. See, insurance is just a risk coverage. It's not an investment vehicle. So what we do normally is that we take an insurance policy, as he said, a term policy, which is good for